today is exactly what you can do to lessen your risk as a business owner for the risks that actually you're going to incur in running a business in general. So, today we're talking about how to mitigate risk of running a business, and we're really talking about the separation of liability, of guarantees that you're supplying, and how to stop all of that, how to stop being personally liable for what's actually taking place in your business. So, if you look at Inc. Entrepreneur, Fortune magazine, Forbes, they all say the same thing. But most important aspects of running a business is to let the business stand on its own, to separate yourself from the business. Now, there's a lot of reasons that you want to do this. First of which is just personal liability. You're not liable for what actually takes place in the business, which means, for example, that if the business defaults on a loan or a credit line or a credit card, well, they're not going to come after your personal assets when it comes as an example of guarantee and personal liability. But in order to do this, in order to ever get yourself to a point where you need to separate consumer, or where you need to separate liability, then again, what it really comes down to is your business being able to stand on its own. So many people say to me the exact same thing. I want to stop providing personal guarantees in my business. Well, you can do so. But in order to do so, there's one thing you have to do. The business has to be able to stand on its own. If the business cannot stand on its own, you can never separate that liability, which means whatever that business incurs, you're going to be liable for. So how do we mitigate this? How do we stop this? How do we stop you being liable for what you're actually doing in the business? Well, there's a lot of different ways to do it, and that's exactly what we're going to decode right now. So first of all, let's look at the very first steps. The very first step is your business needs to have its own entity set up, right? And by the way, if you're just coming in, tell me where you're coming in from. Give me a shout out. Tell me where you're coming in from. I want to make sure that I can say hello. I'll even give you a call out to your business. Give your business a call out here if you mention your business name. So that being said, the very first thing you got to do is you got to set the right kind of entity. Now, preferably, you want to set up a corporation. You may also want to choose an LLC. You never want to be a sole proprietorship. A sole proprietorship, you are the business. You and the business are one and the same. That means if the business ever gets sued, you get sued. I'm not an attorney, and this isn't legal advice, but this is how the system works, right? The same thing. If you default on a credit card and you are a sole proprietorship, you'll always be liable for that because you and the business are one and the same. So the very first thing we do to mitigate risk as a business owner is we create separation. We create separation between the business and us. We are a person. We've got a social. The business is its own entity. It has an EIN. The two are separate. We've got to create clear separation between these two. So the easiest way to do it is set up a corporation for the entity. A C Corp, S Corp, doesn't matter. That's the best way to do it. Now, we can also choose an LLC as a second option, but a corporation gives us the most credibility in the world, whether it be lenders, credit issuers, suppliers, insurance companies, potential clients, prospective clients themselves. Everybody sees us as more credible for a corporation. If we can choose it, we choose it. If not, we go with an LLC. Very first step, got to get away from a sole proprietorship. Now, everything needs to be set up separately for that business. So what I mean is that the business needs its own address. The business needs its own phone number. The business needs a website. It needs an EIN number instead of using your social. And the business needs to become its own thing, right? I even get a license with the business. The business needs its own bank account, right? Everything that you would really have if you're applying for a personal loan, the business is going to need to have. So those are just a handful of the things. We call this fundability, and creating that separation is very important. Now, you may be saying, and a lot of people do, hey, what if I don't do that? What if I use a home address, for example? You can do that. But the problem is that without this complete separation, then you can't be surprised when lenders and credit issuers won't approve you for a corporate credit card without using your social security number, right? So if we think about it, that's kind of the way the world works. You're either willing to create the separation or you're not. You create the separation, then you can't be surprised that lenders and credit issuers want to use your personal credit, your social security number, and your guarantee on the business debts. So the very first step to take is you have to create a separate entity, and everything there really should be separate. The business has its own phone number and its own address and its own bank account. Okay, it has its EIN versus a social security number that you have. Now the business can start standing on its own. It's the very first step is that you've created the separation between the two. We understand we don't want to be liable for what's going on in the business. Now we've done the first step, which is create a separate business, a separate entity, and we've got everything separate for the business than us personally, than us individually, right? Okay, so and by the way, I am says if my business is classified as a single member LLC, can I really separate myself from it? You can, but here's the key, and I'm going to pull this question up because I think it's a great question. The key is that an LLC is not really an entity. It's not actually an entity on itself. It's layered on top of something. So the answer to your question lies in what kind of entity you have set up. Meaning that you can have an entity and an LLC over it, but the LLC isn't the entity. What I mean by that is that you can choose a sole proprietorship and you could layer an LLC on top of that, but it's still a sole proprietorship underneath all of that. So the answer to your question lies in what kind of entity you have set up. You need to make sure that you have a separate entity set up, and it can be a corporation. It can be an LLC. It just can't be a sole proprietorship. If you've done that, you're well on your way. And we got Miami in the house, and Philadelphia is in the house as well. I am from a Philadelphia Therapeutic Touch Wellness Spa. Thanks for coming in. I appreciate it. The 3 big C's. I'm keeping that concept. I love that. All right. So very first step, we've got to come in and we've got to set our business up separate from us, separate address, separate phone number, separate email address. Email address I didn't mention, by the way, I did just now. Everything has to be separate from us. Once we've done that, now the next step is letting the business start standing on its own when it comes to the perception that lenders and credit issuers have. Meaning that if we don't want to guarantee the business debts, then we have to prove that the business itself is capable of making its own payments, right? And what's nice about this is even if our personal credit's bad because we had credit issues, then it even gives us a compensating factor when we go to get loans and credit lines, because we can say, hey, look, maybe my personal credit's bad, but my business always pays its bills as agreed. And that's what we've got to set up. We've got to set up this world where the business can actually start proving itself. So lenders and credit issuers want to lend money to that business instead of you individually. So let's just take an example. Michael Dell doesn't personally guarantee Dell's debts. Now you might be saying, yeah, Ty, because it's Dell. But no, it's not because it's Dell. It's because if you look at Dell's credit report has hundreds of accounts they've paid as agreed. And the value of those, the limits, the lines are way higher than Michael Dell as an individual has ever seen. So what's happened is the credit report of the business has become more valuable than that of the business owner. That's why the business owner doesn't matter anymore. We don't need the guarantee. We don't need the credit check from the owner. It doesn't matter. The business can stand on its own and honestly has way more clout than the individual does. That's how it all progresses. What we want to do is we want to create this credit profile that shows more depth than they'd ever see on the individual level, right? So I'll give you an example. I can pull up a credit report right now that I often use as examples, and it shows the credit limit recommendation that they're telling lenders or credit issuers is to give this person $724,000 in financing. You are never going to have that as an individual. You're never going to have the credit reporting agencies tell lenders, hey, give this guy a $725,000 loan. Give this girl a $725,000 credit line. It's never going to happen. But in a business, that's very common as you continue to get the business to prove itself. The credit limits get higher and higher and higher because the credit recommendation gets higher and higher and higher. So that's what we've got to do is we've got to get the business build its own credit profile and score. And that profile and score has to become more valuable than our personal credit. So eventually they stop wanting our personal credit and they just look at what we've already done for the history of the business and they're making the approval decision based on that. Until we get to that level, they're going to need us to personally guarantee. They're going to be doing personal credit checks. They're going to be making checks based on personal credit or based on approvals based on our personal credit quality. Now, this happens through time, meaning that eventually we start here. Our personal credit's more valuable. So we get starter vendors and our business credit has a little bit of value. Then we start to get some retail credit and some fleet credit. And eventually what happens is the more credit we get, the more credit becomes available based on just this credit profile as this credit profile is growing and becoming more valuable to a lender than our personal credit profile. Eventually, you get to a point where, like Dell does, where they don't need the individual anymore for any kind of financing or credit because the credit report is so deep, what I call it. It's got so much depth. There's so many accounts on there. The limits are so high. The loans, the credit lines, there's so much to that business credit report that the individual credit report doesn't even matter anymore. And it will take you time to get there. But here's the good news. As you're going through this building process, then what will happen is the business itself, the credit report of the business itself will start to qualify for more and more and more and more money without you. First, it's starter vendors. Then it's retail credit. Then it's fleet credit. Then it's auto financing. Then it's Visa cards and MasterCards. And then eventually down the road, when our business credit profile gets really a lot of depth, then we don't even need to supply guarantees on a lot of loans and credit lines, and time as well. That takes time to get to. And a lot of people ask me that, hey, what happens? How long does it take you? What's involved to get loans and credit lines without a guarantee? And I'm like, a lot of work. You got to build a big credit profile with very high limits showing that you've managed that kind of money and work up to that point where you go get a $320,000 loan through SBA. You're not going to go get a $320,000 loan with no guarantee if the highest credit limit you've ever had on your credit report is $5,000. Doesn't make sense, right? So we got to build this credit report up. And as we build it up, more and more money becomes available without the guarantee and without the credit check. So in order to do this, we've got to start building business credit, right? And the easiest ways to build business credit is to start with starter vendors. These are vendors that will give us credit when we have none. This is a Uline, it's a Grainger, it's a CEO, a Creative, or a CEO, or let's say a Creative Analytics is another one. So we get these starter vendors. Then we start to spend money on them. Then they report to the business credit reporting agencies. Then the next step that we take is we still go get more credit. We start to get credit with retailers. We start to get credit with fleet sources. We start to get auto financing and Visa card and MasterCards. The more accounts we add to the credit report, the higher the recommendation of credit becomes. The higher our approval limits become as well. And the more and more and more money we start to get approved for, and the more money becomes available to us without the guarantee and credit check. This is where people mess up building business credit. They build business credit just to build it. And what I mean by that is they get all the credit they can get in step one just to get to tier two. But then they only spend $50 in tier one. And they just spend as minimum as they can to get to the next tier. But when you do it that way, you're never going to have high limits because nobody's going to give you a $10,000 limit credit card if they've only ever seen you spend $100 on the credit you've been given. You've got to get credit you're going to use. You got to use that credit to grow your business. Then you pay it off. Then this cycle of using the credit you're given gets you higher limits. Now I got a $2,000 Staples credit card and I spend $2,000 on it. Then I go to get Office Depot and they give me $4,000. They say, this guy is already spending $2,000 at Office Depot. I think I maybe reversed it. So now I'm easily going to give him $4,000 because if Office Depot only gives him $2,000, I'm going to give him $4,000 because I want him to bring his business over here, right? And if his limit's twice as high as it is with me than it is with them, they're more than likely going to spend more money over here. So that's what happens. These credit issuers literally start to compete for your business. They start to raise your limits higher and higher because they want to be the highest limit account, so you spend all your money with them. But in order to get them to want to compete for your business, you've got to show them you're going to use the credit you're given. If you're not using that credit you're given, they're never going to give you higher and higher limits because they don't want your business. They don't care about you if you're only spending $100 every time you go to buy something at Staples. They don't care. They want the person that's going to spend $1,000. $2,000, $5,000, $10,000, because that shows the business is growing, and that's how they make their money on interest, on fees, etc. That only happens if you're actually using the credit that you're given. So some things to think about there. Hey, JNS Enterprise SC of South Carolina makes sense, says Facebook user. I love that. Okay, so this is exactly how we get away from personal guarantees. It's a matter of continuing to build that business credit. Now, the third step is you've got to access financing. So first step of mitigating a risk as an entrepreneur, we've got to separate ourselves from the business. We've got to build the separate website, the email address, the phone number, the address for us, the business. It's all going to be separate, completely separate from us as an individual. Entity set up, LLC, corporation, etc. Then we're building business credit. Now we're building a business credit profile, showing lenders and credit issuers that we're getting credit, we're using credit, we're paying our bills. And as we use more and more money on those credit limits, our credit recommendation gets higher and higher and higher and higher. Now, the next step is we've got to come in and get financing. So here's some statistics. 29% of businesses fail due to running out of cash. 82% fail due to cash flow programs, due to basically issue with being able to manage their cash flow. So the biggest reasons that business owners fail is lack of access to money. You have to be able to get the money you need when you need it. If you don't have this, then it creates a lot of problems. And then if you did guarantee everything in your business, they come after your personal assets. Trust me, I've been there. I've literally been the guy that had the business debtors come in and take all the money out of my personal bank accounts, clean them out, because I defaulted on business debts because I provided a personal guarantee. You don't want that. We got to create some separation. So how do we do that? Well, the easiest way to do that is we need to be able to line up financing to get it when we need it. Now, building business credit helps us because our business credit profiles control our ability to get loans and credit lines. The better our business credit is, the more types of financing and credit become available for us to get, right? So that's a very important part of it. The second thing is that we've got to understand what lenders are looking for, and we've got to make sure that we have those strengths. Somebody mentioned earlier here, hey, the 3 C's that stick with me. Yeah, and that was Donnell. That's it. Cash flow, credit, collateral. In order to get money from the system, loans and credit lines, we need one of those 3 things. We need good personal credit or business credit established. We need to have cash flow consistent for 6 to 12 months, or we need to have collateral, one of those 3 things. So as our business starts to generate cash flow, it starts to accumulate account receivables and we get inventory equipment, it starts to accumulate assets. As this starts to happen, then naturally it becomes easier for us to segue and get away from personal guarantees. We create more separation. We're not personally liable for a lot of the debts we're taking on. And then we're able to start, again, mitigating the risk of us owning a business because we're not personally liable for those debts. Now it starts based on the C that we have. So if I have consistent cash flow, then I can get what's called cash flow financing. Money in 72 hours, up to $500,000 in funding, depends on how much revenue we have, determines the loan amount. A lot of cash flow is available with no personal guarantee. Once we just show the business can stand on its own and start generating revenue, we immediately can use that established revenue as a way to be able to get away from guarantees, get financing with no personal liability, no personal guarantee. What's the other C, right? The other C is business credit. Credit, C. So as we build that second C, business credit, we start to get more and more and more revolving credit without a personal guarantee and credit check. Now here, what's the third C? The third C is collateral. So again, how do we get away from liability and guarantees? Well, in that third C, as we start to accumulate collateral, more financing becomes available based on those assets that we're pledging as collateral without guarantees and credit check. Inventory financing. A lot of equipment financing we're able to get. Account receivable financing, 401k, stocks, bonds, IRAs. All of this financing becomes available to us based on us having an asset without guarantees. So literally, as the business grows and we're following these steps, separating ourselves from the business, becoming fundable, building business credit, now as the business starts to get revenue, we start to get away from guarantees on revenue type financing. And the business gets assets and collateral, we start to get away from guarantees with collateral-based financing. The business builds business credit. We get away from guarantees with credit cards, with credit-based financing. And eventually we get to a point where we can even get hundreds of thousands or even millions of dollars in financing and credit without guarantees and credit checks if we're following this process. So this is exactly how it works to mitigate risk, get away from personal guarantees, get away from personal liability. These are the 3 steps to take. Separate ourselves from the business, separate it from us, right? Create that fundability where the business has its own address, its own phone number, its own license, and its own entity set up, and its own email address, everything separately. Then we start building our credit profile for the business, and the more we do that, the more the more credit we get, the higher our credit limits, the more credit becomes available without a guarantee, and eventually we're getting $50,000 limit accounts without guarantees. One of our clients, Christine, got $300,000 credit line without a personal guarantee, $185,000 at Ford without a personal guarantee. Another one of our clients has got approved for $350,000 in auto financing without a personal guarantee, right? $350,000. I mean, literally, I shared that approval on my last webinar that I did a week or two ago, I think last week. $350,000 approval without a guarantee. So eventually, as we follow this cycle, we're able to get hundreds of thousands or even millions. And again, the last stage is accessing financing based on our strengths, cash flow, credit, collateral. And as we develop those strengths, more cash flow in our business, collateral and assets in the business, then more of that type of funding, it becomes available without a guarantee. And eventually we're able to get term loans and all those kind of loans without guarantees and without credit checks as well. Those are the 3 steps to actually make it happen. So John says, hey, how do we get back and get the smaller vendors to match our new $10,000 limits? You don't. Well, you use them and ask them to raise your limits is what you do. I recommend everybody asks to have your limits raised every 3 to 6 months. Discover on the personal side and business side lets you ask for it every month. You can ask for a credit limit increase. If they do a credit check, I don't allow it. But if the answer is if you got a $2,500 approvals initially, then you're up to $10,000 limits. Make sure you're still using those $2,500 accounts and go back and ask them to raise your limit. Now, when they re-pull your credit report, they see the recommendation of credit is much higher on the credit report. They see you've got other equally high limits on there as well, and then they're going to start to raise your actual raise your credit limit recommendations in kind. So hopefully that helps you there. As a matter of fact, I've actually got a guide on building business credit too that I think can help you as well. I'm going to pull that up on the screen. This gives more in-depth, more vendors, more in-depth in the steps of building business credit. So if you'd like that help, just scan that QR code. I think the link is right there as well. creditsuite.com/EIN you can go to. And Quentin, thanks for coming in and saying hello. And Danelle, thank you very much again for saying hello again to it. Appreciate it. So there, that being said, I'm going to go ahead and wrap it up. Now you understand the 3 steps for us to mitigate risk in running our business, separate ourselves from the business, separate our liability, get away from guarantees. Now you know what to do. We're improving that fundability, separating our business structurally from us. We're building that business credit. We're getting financing based on a strength. And if we're following this process and using the credit we're getting, then our limits and recommendation of credit gets higher and higher. And eventually we're able to get basically every type of loan, just like big companies do without guarantees and credit checks. So if you'd like to learn more, make sure you go right there and scan our QR code, creditsuite.com/EIN. You can go there or scan the QR code. And that is my in-depth guide on building your business credit. So now you know everything you need to know to mitigate risk and separate liability for you and your business. So I look forward to seeing you next time at our next training where we talk about more cool ways to get the money you need to start and grow your business. Take care. Have a great day.